Welcome to the InterMarket Analysis video update. This is a video that I do once a week in conjunction with a number of different videos where we look at a couple of different things here. We look at the valuation of the S&P 500, not only on a historical basis, but also on a forward-looking basis. I'll also go through a pretty intensive study between growth and value. Growth is when you want to buy low and sell high. Value is what the market tends to get into when we're more defensive or actually looking at a decline. And then we also look at other markets because sometimes we can get some insight as to what's happening with stocks by looking at other markets that are outside of the stock market. This is being prepared for Monday, July 8th. Before I get started, I do have a thing called the SPX Investing Program. It launched at the beginning of June. It's still free for right now. I will be locking it down at some point in the future. It'll be $97 a month. It's a membership program. If you want to learn more about this program, there are links in the video, in the description that I post with every video that I upload that tells you more about the program. I have a series of videos that go through that. And there's also a link that will take you to the SPX Investing website if you want to check that out. Another thing is sometimes I get questions. It's like, okay, this intermarket analysis video, it's all fine and dandy, but what does that have to do with what's going on in the stock market? That's because I post a number of different videos each week. There's so much information that we really need to go over to get a good handle of what's happening with stocks. And I put out not only this video, intermarket analysis, I have another video that I call a deep dive video, a what to watch video. I do supplemental videos and I do a weekly video. All of that ties into the middle area here, which is the daily video. Over the decades that I've been doing this, I have found that it's the daily video that helps us the most. We can really get some insight. We can see things developing before they actually happen. We can take action quicker by looking on a day-by-day basis. And so all of these other videos that I do just tie right into ultimately the daily video. The first area that we look at is S&P 500 valuation. First, we look on a historical basis, and then we look at a projection basis by looking into the future. This chart shows on a historical basis using a thing called TTM, or the trailing 12 months. These are earnings reports that have already come out, and then they're compared to the current price of the S&P. And we have a number of different levels here, 10, 15, and 20. When we're at this red dashed line, which is a level of 20, that's a PE ratio showing that the market on a historical basis is overpriced right now. We're considered expensive, or maybe even overvalued, you could say. But looking at this, going all the way back to 1980, you can see that we can spend years above this red dashed line, and that's where we're at right now. We don't use this to make decisions. We just use this to evaluate the market and say, okay, based on earnings that have already come out, the S&P is considered to be expensive currently. We can also look at this in the context of different major events that have really hit the markets and what the valuations were at that time. This is another chart that's showing pretty much the same thing, but it's going back further to 1970. And we're into this overvalued area, but we've been here for a long time. There's another way of looking at historical data by using a thing called the Shiller PE ratio, developed by Robert Shiller. And this goes all the way back into the 1800s. And currently the reading is 36.25. To give us some context, this is a historical chart and what the value was of the Shiller PE ratio at that time. We can also look at the median and the mean to show that we get between 16 and 17. Well, currently we're at 36.25. So even by looking at things this way in a more smooth approach, we are still considered to be overvalued. But the market looks forward. And here's a chart showing a number of different indexes. We have the mega cap 8, as well as the S&P 500, the mid caps, and the small caps. The purple line shows the forward-looking PE ratio of the big mega cap stocks. And we're well above 30 right now. We're at 30.7. So even looking into the future, the mega cap stocks are considered to be expensive right now, but the market doesn't seem to mind that. They're hoping that things will even get better going off into the future. We compare that to the S&P 500, which is the red line, and we're also expensive that way, coming in at 21.3. Then more fairly priced are the mid caps and the small caps, but they haven't been performing all that well. We, again, don't use this chart really to make decisions. We just want to know the current condition, not only on a historical basis, but forward-looking basis. But then we use other charts to determine the trend and what's actually happening with these other indexes. And the mid caps were pretty strong earlier in 2024. The small caps never really got off the ground. They had a good December in 2023, but then just went sideways in a range for all of 2024, at least to this point. So you might think, oh, the valuation is low here, I better get into that. Well, that's what a fundamental analysis investor would do. But looking at the charts, it's really not suggesting that these areas are very strong right now. Then we also look at the earnings season that's going to be starting here pretty soon. We just ended the second quarter in 2024, and now these earnings are going to come out. And according to Deutsche Bank, it says that we see S&P 500 earnings per share rising sharply in the second quarter as their earnings are going to be released, while the consensus sees them going sideways. Okay, everybody has an opinion about these things, but Deutsche Bank is a little bit more optimistic with the purple line, where the consensus does see it going up, but not with the same amount of strength. This looks at forward valuations and says they are priced to perfection. We're getting near the upper boundary here. This is a standard deviation, and I use some of this in my analysis. We're getting kind of to the higher end right now, but they seem to like this according to this particular chart. And then this is seeing a lot of inflows going into bonds, which could end up really helping stocks. When people buy bonds, that pushes the price up and that pushes interest rates down. And we've been in that kind of an environment where lowering interest rates tends to give support to stocks. Now we go through and look at growth versus value. The first thing I look at is just a pure growth index. So we're looking at growth all by itself, and it's in a pretty solid uptrend and really doing quite well these days. Not back to an all-time high, but it is performing with a pretty solid uptrend. We also see value that's in an uptrend, but you can see how it's trailing off a little bit. It's been underperforming lately. Where we get some insight is when we do ratios between the two. Growth versus value on the top, showing how growth is outperforming, and value versus growth on the bottom, showing how value is underperforming. And in a good solid bull market, that's what we see. Then we look at this a number of different ways to give different context. Here's a couple of growth versus value ETFs showing how growth is outperforming, and this is a longer term chart. This is an inverse of that same chart showing how value is underperforming growth. Then we look at those same pure growth indexes that I started off with and also do a ratio between those showing how growth is really starting to outperform value. Here's an inverse, but a shorter term look showing how value is underperforming growth. So we're seeing confirmation here. These are some other indexes showing how growth is outperforming value on this chart. And then we look at some other ETFs. And I've been showing this a lot in other videos, but we're well up out of the rainbow and going up when we compare growth to value with these ETFs. This is an inverse of that same chart, showing how value has been underperforming growth. And I do that. I like to look at different lengths of charts. I look at inverse charts because sometimes we might see something that we would miss otherwise. Then we break this down a little bit more. I look at small cap growth to value, and this really isn't doing all that well right now. That's one of the reasons the small cap index has been languishing and chopping sideways for pretty much all of 2024. The mid caps not really doing all that well either. In fact, we saw a recent death cross with the growth to value ratio here, but the mid caps had been doing better, and now they're just kind of chopping sideways and even drifting somewhat lower. This is the one that I pay attention to the most because it's S&P growth to value taking a ratio, and this is looking much improved lately. We're actually breaking out with this ratio compared with earlier values for the ratio. We keep an eye on inflation. We look at a monthly chart of the CRB index, which are commodities, and that's continuing to go sideways. We're still in an uptrend there. And then we do a ratio between inflation and deflationary areas. And this is continuing to be underneath a declining moving average, but it has been bouncing up a little bit lately. So it's really suggesting that we want to keep an eye on this to see if this inflation part starts to go up. But because the moving average is going down, it just means inflation has also been going down. We look at a daily chart of the CRB index, which are commodities, and here's a breakdown over here of the CRB index, where we are in an uptrend right now, but we've been chopping sideways for the last few months. We look at the Baltic Dry Index. This is what does it cost to ship products from point A to point B, specifically in the Baltics. This is still showing kind of a weaker uptrend here. When this really goes up, that tends to be inflationary. When this goes down, that's more deflationary. Then we keep an eye on some other markets like aluminum, where it's continuing to be in an uptrend. We look at corn, which had been bouncing back up, but now has been falling back down. Wheat, kind of the same thing. It really started to shoot back up, but has since really started to fall back. Keep an eye on fertilizer because that's the very important product that is needed to grow food. And this is really not breaking out all that much, and it has actually been declining recently. Keeping an eye on oil, this affects all of us anytime we fill up our cars or trucks. We're getting back up into the 80 range now, where we dropped down into the 70 range for a number of weeks. We'll have to see if this continues to go up. That could be more inflationary, and that's something that we really feel as consumers because it's such a big part of us being able to travel and go places. Here is gas all by itself. It's kind of chopping around, but it's still in an uptrend. And then we look at diesel. This is mainly for railroads and 18 wheelers, where this has been going up lately, but and this is the spot price. This means what is it right now? This is not futures. This is not projecting out what they think the price will be. This is where we're at currently. And it's been coming back up a little bit, but overall, in the bigger picture, the price has been declining. Heating oil, don't need a lot of that in the summertime unless you're in the southern hemisphere. This is still in a downtrend. Natural gas, which really got hit hard, was bouncing back up and now starting to come back down. Copper, we look at this because it's more of a barometer of the economy. When copper's going up, that tends to forecast or predict that the economy is looking good going forward. When copper's in a downtrend, that can quite often signal that we're going to run into some difficult economic times. We really shot up, and copper was just going up and up and up. Since then, it's pulled back, but now it's starting to bounce back up here, but it's in a longer term uptrend. We look at a copper to gold ratio to see which one's performing the best. Lately, we saw a breakout of copper actually outperforming gold. It pulled back, but now we're starting to see copper bounce back up slightly. This is a longer term look at that same chart. The black line is the copper to gold ratio, where overall it has been declining as we've been going through some economic weakness. And then just to give it a little more context, there's the 10-year yield and the 2-year yield that are also plotted on this chart just to see what interest rates are actually doing. We look at gold. This is the gold ETF. This is not the futures price for gold. And after really breaking out, and we're in an uptrend, we pretty much have been chopping sideways lately with gold. We also keep an eye on silver, which is also in an uptrend. It was starting to break out, fell back, and now it looks to be improving slightly. Then we look at the closing price for gold on top and the closing price for silver in the middle area, and we see that there's a strong correlation between the two. And that kind of goes with logic. We tend to treat silver and gold as one unit with their relationship typically being pretty strong. And we have a gold to silver ratio on top. When this is going up, that means gold's is outperforming. When this is going down, we've seen a little weakness here. That means that silver's outperforming. And then what's interesting is we can place the US dollar index in the middle area. And sometimes we get some insight from this, meaning that this ratio on top is having a fairly strong, but not really strong correlation with each other. We keep an eye on these other markets because they can ultimately have an impact on stocks. Here is the dollar, which can really influence stocks. It's been in a longer term uptrend here on the daily chart, We did pull back later in the week this past week, and that did give some support to stocks like a weaker dollar. This is looking a little further out where we finally broke out above this trend line, and we broke out and we're looking pretty good, but since that time we've been chopping sideways. Keeping an eye on the euro, which is now turning over and going back into an uptrend when compared to the US dollar. And we're not seeing an awful lot of strength in the euro itself. It's a little bit of weakness that's been developing in the US dollar index. And these charts are pretty much mirror images of each other. Even though this is the dollar index, which includes other currencies, the euro is the most influential currency compared to the US dollar. We also keep an eye on the Japanese yen, which is just continuing to go down. We also track that with the euro and then the US dollar index on the bottom. And then I have a breakout chart here where we had been seeing that the euro was in a downtrend compared to the dollar. Well, it's starting to bounce back up as the dollar's shown some weakness. And we're just starting to see a golden cross here as the euro is changing from being in a downtrend of the dollar, now going into an uptrend. But the Japanese yen continues to really underperform the US dollar. The British pound is also in an uptrend compared to the dollar. And we look at some different indexes. I do use this in the daily video. The bar chart here is the S&P 500, which is a weighted index. So the really big stocks have more of an impact on what that index does, where there's another index that's more equal weight, where everything is treated the same in that index. When we're dropping below and actually going down, that means that the broader areas of the S&P 500 are underperforming the really big stocks. And we look at a ratio here. I have a different chart that I quite often show. This one shows the equal weight index and how it's been underperforming the S&P 500 as the big stocks are having most of the impact. Then we do a ratio between stocks and commodities, showing that stocks are outperforming. Here's an inverse showing how commodities are underperforming. We look at the NASDAQ 100, which is just setting an all-time high, and the S&P 500, which is also setting an all-time high. They're both doing quite well independently, but the NASDAQ 100 is doing even better. We look at the S&P 100, which are the biggest stocks that make up the S&P 500, showing how the 100 stocks are really outperforming. The NASDAQ, which is also coming off of all-time highs, and the S&P 500, this ratio shows that the NASDAQ is outperforming. And the NASDAQ 100, which is doing really well, and the NASDAQ, which is doing really well, we're seeing a little bit of a breakdown here. Now, you could take that as negative, meaning that the NASDAQ 100 isn't really showing a big outperformance right now. You could take this as positive, meaning that, oh, there's more stocks inside the NASDAQ that are actually doing well, and that's why we're seeing this ratio going down. We look at the mega caps, the really, really big companies, and compare it with the equal weight index, showing how the mega caps continue to outperform. Small caps continue to underperform. The red line is a ratio of small caps to the S&P, and then the blue line is the S&P itself. And we're seeing a real divergence here. As the S&P has been going up, this ratio has been going down. And then we look at small caps and take another ratio with the S&P 500, showing how small caps continue to really underperform. These are the biggest software companies in the US, and they really haven't been breaking out and showing an awful lot of strength, but they came down to their 200-day moving average, and they're starting to bounce back up, seeing a little bit of an improvement. Here's the mega cap ETF all by itself, just going out and setting all-time highs. The robotics and AI ETF, it's looking pretty good. It's at the top end of its rainbow when you look at it independently. But when you compare it to the tech sector, it is continuing to really underperform. The Dow Jones Composite, which takes the Dow, the transports, and the utilities, puts them together. This is still in an uptrend. And we're seeing kind of pockets of strength and weakness along the way. The Dow is kind of chopping sideways, hasn't set a new all-time high as recently as the S&P and NASDAQ 100 have. The utilities are really lagging right now. They're showing some weakness after they had been seeing some strength, and the transports are just really weighing things down currently. Then we look at the S&P 500 and compare it with short-term bonds based on price. This is showing how stocks are outperforming. We look at a broad market measure, the S&P 1500, and they're also performing shorter-term bonds. We look at another broad market measure and compare it with 3 to 7-year bonds, showing how stocks are outperforming. This is the total U.S. stock ETF made up of 2,651 stocks, setting an all-time high on Friday. Low volatility stocks. This is what people like to get into and hedge funds and the smart money when they're really worried about the market hitting a difficult time or a decline. When you look at this independently, we are in an uptrend. So these stocks have been holding up better. But when you compare it to the S&P, they are really underperforming. Then we look at the tech sector and compare it with 3 to 7-year bonds, showing how the tech sector is outperforming. Then we're a little concerned here. The advanced decline line studies. We're not seeing an awful lot of strength these days. With the NYSE common stock, we're below the moving average and declining. And the S&P 500 is right on top of the moving average, even though it set an all-time high on Friday. The mid caps and the small caps are below their moving averages and declining. Then this is traditional Dow theory, where we haven't set a new high here recently, but the Dow's been holding up okay. The transports have really been underperforming, and the utilities were really coming on strong, but now have been pulling back. We break out transports to see that they just haven't been doing all that much. They have not been able to come back and set shorter term highs, let alone the all-time highs set back in 2021. That would really help the market if the transports could really start to improve, but they just haven't been doing that. This is a ratio between transports and the S&P 500. When this is going down, that means the transports are underperforming. We look at another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. We look at the relationship between the S&P 500 and the transports, and it's not a real strong relationship right now. The S&P's been going up as the transports have been pretty much going down or sideways at best. Then we look at a new idea behind Dow theory, where instead of using the Dow, we use the S&P 500, which is setting an all-time high. And instead of using the transports, we use the NASDAQ, and that's setting a new all-time high after Friday. So these are confirming each other. But then we break that down a little bit more, and we're seeing a bit of a concern here, where instead of using the S&P, we use the S&P equal weight. And you can see that hasn't come back and set an all-time high yet, even though the S&P weighted index has been setting all-time highs. What's a little more encouraging is we are starting to break out with the equal weight QQQs, which is the NASDAQ 100, and this is showing some improvement. We're wondering if this breaking out is going to end up helping the S&P 500 equal weight. The FANG index, these are the really big companies. It's setting an all-time high and was doing that pretty much throughout the week. If we start to fall, I have different areas that I'll try to pick out as possible support, but since we've been going up, this chart really hasn't been helpful. The Wilshire 5000, which is another broad market measure, setting an all-time high on Friday. ARC has been really having some difficulties, and not only on the daily chart here are we in a downtrend, but we're also in a downtrend on the weekly chart. Then the all-world ETF here, when you take out U.S. stocks, they're looking pretty good when you look at them independently. But when we do a ratio between them, the SPY is really outperforming the rest of the world. This just means that U.S. stocks are doing much better these days. Then this is a monthly chart of a ratio between the S&P 500 and stocks in Europe, Australia, Asia, and the Far East. This ratio is going up, meaning that the U.S. stocks are outperforming. We also plot a momentum oscillator here, showing that this is going up, and that just also confirms in the bigger picture that U.S. stocks are doing better. And we look at bonds. These are bonds based on price. We are in an uptrend with the total bond ETF. The Pring World Bond Index is in a downtrend here. So U.S. bonds are doing okay, but the world bonds are not doing all that well, and that's what's really dragging this measure down. We look at a monthly chart and do a ratio between stocks and bonds, and this shows that stocks are outperforming bonds. This is a daily chart, which is kind of confirming this on a shorter term time frame, how bonds are underperforming stocks. These are high yield corporate bonds. We also know them as junk bonds, setting new all-time highs recently. Corporate bonds, which are more conservative, they're doing okay here, but they're not really breaking out. We do a ratio between junk bonds and more conservative bonds. This is what we're keeping an eye on. We're coming back down into the rainbow. The market is anticipating possibly some economic weakness. If that's true, that means interest rates will fall to try to stimulate the economy. And folks may be starting to get out of the riskier bonds because they give you a better yield, but yet you have to assume more risk. And they're getting into more conservative bonds like government bonds because they're considered to be very safe. And if we are getting to a point where interest rates have topped out and will come down, folks want to get into the more conservative bonds and generally longer term bonds because you can lock in that rate for longer when you get into those types of bonds. But we've been faked out by this before. We've come down into the rainbow only to turn and go back up. And so we're watching this to see, is this going to be a little bit different this time, or are we going to get faked out like we were previously? We do a correlation between stocks and bonds, and they're neutral right now. They're not really moving in the same direction or in opposite directions. This is the Dow Jones Corporate Bond Index showing how corporate bonds are in an uptrend, but really not breaking out, at least yet. We look at some fib studies on the 10-year yield, and we're right in between these lines, so we're not getting any insight there. This is a long-term look at the 10-year Treasury yield, where for 40 years we were seeing lower highs and lower lows, thinking that we're going to be in this low interest rate environment forever. Well, since the whole COVID plunge and now what we're dealing with economically, we are starting to shift to a higher interest rate environment. Here's another fib study based on the 30-year yield, but we're not really getting much from that currently. This is looking at stocks and how are they performing against the rise or fall in the 10-year yield. The S&P is outperforming. And then this is looking at 3 to 7 year bonds and comparing it with stocks. When this is going down, that means the bonds are underperforming, or to say it another way, that means that stocks are outperforming. Junk bonds, which are coming back and setting new recent all-time highs, more riskier bonds here. And we do a ratio between junk bonds and government bonds. This had been coming down, but we're not quite breaking below the moving average when we look at this ratio. If we're topping out with interest rates at some point and then starting to come down, we would usually see this ratio coming down, but it really isn't doing it all that much yet. Here is the 7 to 10-year Treasury bond ETF. We have been going back up based on price as interest rates have been coming down. This is a daily chart showing how yields more or less have been declining. We did start to spike back up, but in Friday's session, we really fell, and that gave support to stocks. This is a weekly chart looking internationally with US and UK rates falling this past week. German rates went up. They just had an election in the UK and they're dealing with an election in France, and Germany might be feeling kind of squeezed in at that point. And Japanese rates, that's the red line, are starting to go back up slightly, but they're still quite low. We look at volatility, and we measure the volatility in the bond market by looking at the MOVE index, where volatility has been dropping off. Then we also look at volatility in the stock market, and this continues to be quite low, but the correlation between the two, they're almost going in opposite directions. This is not measuring price. This is just measuring volatility of each market. Then here's another monthly chart showing the long-term bond price, which has been in a downtrend here for a considerable amount of time. And we do a ratio on the bottom between the long-term bond price and commodities, showing how bonds, even though they've been in a downtrend, are outperforming commodities longer term. Now, what I do in this section is I look at the individual sectors. There are 11 sectors that make up the S&P 500, and then I do a comparison with how is that sector performing compared to the S&P 500. And I list this based on the alphabetical symbol here, so there's really no reasoning going into this other than that. We look at materials, which are in an uptrend when you look at them by themselves. And then on the bottom, the green line is momentum. Right? Is it going up or is it going down? And then the red line is the relative strength to the S&P 500. And we're seeing a little bit of weakness here, even though materials are in an uptrend. But when we do a ratio between materials and the S&P 500, materials are really underperforming. Communication, this has been a stronger area. We're in an uptrend above the 50-day moving average, really looking solid here. Momentum and relative strength are looking pretty strong right now. And we're looking okay here when we do a ratio. The S&P's been doing well and communication's been doing well, but it's not really breaking out at this point, but it is looking healthy. We look at energy, which cannot seem to get above its 50-day moving average. We came all the way down to the 200 for this sector, bounced up, and we're not able to close above the 50-day moving average, but we're still in an uptrend here. We're rolling over a little bit with the momentum and relative strength, but they're still, in the bigger picture, showing some improvement. And we compare it, the energy sector with the S&P 500, showing how energy is underperforming the S&P. Financials, this is an area we keep an eye on. These are all the banks, and both big banks and small banks. They're looking pretty good here. And I showed this chart in every daily video. We're above the 50-day moving average. We're looking okay, but rolling over a bit with momentum, but showing a little bit of an improvement with the relative strength, but we're still below this 100 level. When we're below 100, that tends to be more negative. And the financials are continuing to underperform the S&P on a ratio basis. And right now we're seeing a death cross here with this ratio. That's a bit of a concern. And we just want to keep an eye on the financial sector. Industrials, which are still below their 50-day moving average, but in a longer-term uptrend. The momentum had been positive, but is rolling over. We were seeing some improvement with the relative strength, but now it's rolling over as well. And they really are underperforming the S&P 500. The tech sector, this is the real strong area of the market, showing a really solid uptrend when we look at this by itself. Seeing a little bit of weakness here with the momentum as well as the relative strength to the S&P. And so it's coming down a little bit, but we're not necessarily breaking out at this point, but this has been one of the stronger areas of the market. We look at staples, which when you look at them independently are really in an uptrend and above their 50-day moving average. And this is a more defensive area. And I've been looking at this chart in every daily video because sometimes when things that are more defensive start to really show some favor, that can often mean that the market is gearing up for some kind of either decline or actual shift. And we're looking okay. We're just pretty much neutral right now with the momentum and a little bit negative with the relative strength. But when we do a ratio here and compare it with the S&P 500, staples are underperforming, even though independently they are in an uptrend. Real estate, which is in an uptrend, but chopping sideways when we look at it independently here, the momentum is above the 100 level. We're below 100 with the relative strength, but showing a little bit of an improvement. But when we do the ratio, real estate is really underperforming. Utilities. This is another area that sometimes when this goes up, that can mean that the market is turning more defensive. We had been just climbing really, really high, but since then we've been pulling back and actually coming back down to its 50-day moving average. We're seeing some weakness here with the relative strength and a little bit of an improvement with the momentum. But when we look at it on a ratio basis, utilities are back to underperforming the S&P 500. Even though we saw a golden cross here, as this was coming back up, utilities were really starting to outperform, but since that time have been pulling back, pretty much going back to the beginning of June. And we also look at a ratio between the S&P and utilities. When this is going up, that means the S&P is outperforming. Healthcare, another defensive area. Since you have to have healthcare no matter what's going on economically, we're still battling and trying to get above its 50-day moving average. A little bit of weakness with the momentum and a little bit more weakness on a relative strength basis. And this also shows how the healthcare sector is underperforming the S&P. Discretionary, the thing that makes life fun. A big part of this is Amazon as well as Tesla. This is coming back, and this is encouraging. We want to see tech, communication, and discretionary really doing well. That's what really helps the market to go higher. Well, you look at this by itself, and it's showing some improvement. We're also seeing an improvement here with the momentum and relative strength. But when we compare it to the S&P, it's got a lot of making up to do here. It's still in a downtrend, even though it has been bouncing up. We want to see more follow through with this to be more positive. Semiconductors, an industry group that is really huge in the tech sector. This is looking pretty solid when you look at it by itself, even though the momentum and the relative strength have been showing some weakness. We compare energy with tech. And when this is going down, that means energy is underperforming the tech sector. Growth, the buy low, sell high stocks compared with bonds, which are more conservative. This shows that growth stocks are outperforming. We look at the tech sector and compare it with the 10-year yield. This is showing that the tech sector is outperforming the rise or fall in interest rates. And then here's an inverse of that same thing, showing how the 10-year yield is underperforming the tech sector. Discretionary versus staples. This had been really disappointing as discretionary was underperforming and we saw a death cross with this ratio, but we're starting to see a breakout here. If this could continue, that would be more positive for the market. Here's an inverse of that, showing how staples had been outperforming discretionary, but have been pulling back lately. And we look at a ratio between gold and the S&P. Gold is like, hey, you got to get into it. It's going to the moon. Well, you probably would have been better off just staying in the S&P because gold is not really outperforming stocks. And we also look at gold versus the dollar, where it did break out above this blue trend line here. And once we broke out, we pretty much have been chopping sideways. We're seeing a bit of weakness in the dollar, and we're seeing more sideways action with gold. And so this ratio hasn't really been showing a lot of strength. High leverage loans. And I focus in on this because I look at this from an economic standpoint, and this is really looking pretty solid. When you look at this all by itself here, it's in a solid uptrend and even barely comes back down to its 50-day moving average. This is more positive longer term. If we start to see some real problems in the stock market, we're probably going to see this ETF show some weakness, and we're just not seeing that right now. The NYSE composite, a broad market measure. We are in an uptrend, but not setting an all-time high. All stocks are setting all-time highs. These are stocks in the US as well as internationally. Emerging markets also are in an uptrend. Has quite a ways to go to get back to its all-time high, but they are showing some improvement. The Japanese Nikkei, that's their main index. We're coming back and setting new all-time highs again. These are the micro cap stocks, very small companies. They are in an uptrend, but not showing an awful lot of strength. And we do another study here with the S&P and the Home Builders ETF. And we can see where this ratio is really starting to go down. Home builders have been under some pressure lately, but we're not really seeing any real concerns here with the correlation. Where we really pay attention to this is when they start to diverge from each other and get down into these areas that I've marked in yellow. But right now, they're having a tendency to go in the same basic direction. Bitcoin, which has been doing pretty good and it's still in an uptrend, but lately it's been falling back from the all-time high that it set. And we look internationally where China looks like it could possibly starting to turn back up. Emerging markets are starting to show an uptrend. We're turning back up in Europe. Japanese stocks, not as much strength here. Still pretty much in a downtrend. And we're seeing kind of an upward trend here with stocks in the US. This is a longer term chart, and this uses the KST, which is a longer term momentum oscillator. Intermarket analysis here, which we're just seeing that oil is doing the best going back to the beginning of the year. The black line, that's stocks. And then we have gold and then the dollar, where bonds based on price continue to be negative. Then we look at some correlations. We look at the S&P 500 compared to the dollar, just coming out of neutral territory here where they're having a slight tendency to go in opposite direction. So if the dollar is down, that may help stocks to go up and vice versa. We look at the correlation between the S&P 500 and oil, where they're tending to go in the same direction right now. Back when we saw things escalate in the Middle East, this is when things really started to go in opposite directions because oil can react for a couple of different reasons. It could be a geopolitical event that really causes the price of oil to go up, and that's negative for stocks typically. Or oil can go up because the companies are doing well and the earnings are doing well, and it can trail along with the S&P 500 actually going up. And we're seeing kind of a strong correlation between the two. They're having a tendency to go in the same direction. We look at the S&P 500 and the 10-year yield. They are neutral currently. We look at the tech sector with the 10-year yield. Slight tendency to go in the same direction, but really leaning more towards the neutral area now. And then the S&P 500 compared to the 2-year yield, they're having a pretty strong tendency to go in opposite directions. So if the 2-year yield is going down, that may help the S&P to go up and vice versa. We have some long-term secular, which means decades long trends in the market, or cyclical studies. That's usually shorter term. We have been in a long-term secular bull market for decades now, but what we went through back in 2022 was a cyclical bear market. And this is a monthly chart of the NYSE where we're looking pretty solid and the red line is going up. So longer term, the trend is positive. We also plot a momentum oscillator on here showing that the momentum is positive as well. This is a daily chart of the NYSE, and when this is going up, this is the record high percent index. This is more positive for the NYSE, but it has been pulling back lately. Another monthly chart of the S&P 500 above the moving average, and all of them are continuing to go up. The momentum, as measured by the PPO, is also positive. So longer term, we're still looking good there. Then we look at the S&P 500 on top, and then we do a ratio between stocks and commodities. When this is going up, that means stocks continue to outperform. Here's another monthly chart looking at the S&P 500 and comparing it with global stocks, showing how U.S. stocks are outperforming, seeing a little bit of a tick up here with the KST, a longer-term momentum. Then at the very end of this video, I have a list of all those things that are positive, and then another list of things that are negative. My definition of positive as it applies to this video is when the 50-day moving average is above the 200-day moving average. And it's quite a long list, so it's a little bit small with the type here. We have growth in value. When you look at them by themselves, they are in uptrends. Copper is in an uptrend, the British pound, and now the euro has been added back to the positive side when you compare it to the dollar. Gold and silver, the dollar index by itself is still in an uptrend. The CRB index, which are commodities, the big software companies, the mega caps, the FANG index, the low volatility ETF by itself, when you compare it to the S&P 500, that's when it's really underperforming. Staples and the Dow Jones Composite Average, bonds based on price, everything is positive here except the World Bond Index. The tech sector, as well as semiconductors, high leverage loans, the Dow, the NYSE Composite, and the Wilshire. These are two broad market measures that I look at. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps. Even though these areas have been underperforming, they are still in uptrends. All stocks, emerging markets, and then Bitcoin, even though it's been pulling back, is still in an uptrend when we measure that based on a moving average crossover. Then on the negative side, this is when the 50-day simple moving average goes below the 200-day simple moving average. The Japanese yen compared to the dollar, ARK is in a downtrend, and the Pring World Bond Index as well. Thank you. I hope you found this helpful. If you're finding yourself a little bit confused as to what this video just talked about, please go over and look at the daily videos, and hopefully that will give you a much more confident level of insight as to what's going on in the market. I hope you have a wonderful weekend, and I will talk to you in the next video.